Oh, he's done it! The Wolves booze turns to Chelsea cheers. He's going to break for Nkunku and he's going to hammer it in.
Mudryk takes over, Mudryk's through, Mudryk round the goalkeeper! Oh, it's fantastic! Mikhailo Mudryk!
Cole Palmer, time to smash it! Now Chukwuemeka, lovely shimmy, brilliant! Strong turn from Jackson into Palmer, that's brilliant! Oh, Cole Palmer! We know he's got the pace. Madueke's in the middle, so João Felix!
Hi everyone, welcome to today's sessions. We are very glad to have you here with us. In these short presentations, we will take a quick look at who TMGM is, what we offer, and some of our key initiatives across the years. TMGM is a global multi-asset broker offering a wide range of products, including Forex, metals, energies, index, crypto, US stocks, and various investment products. Our mission is to provide a trading environment that is stable, efficient, and cost-effective for traders of all levels. A quick overview of our journey. In 2013, TMGM was founded in Sydney, Australia. In 2015, we have developed our own global financial system. In 2018 and 2019, we have expanded into multiple regions, including Melbourne, Philippines, Adelaide, and Taiwan. In recent years, we have actively supported global sports events and athletes and expanded our presence through entertainment partnerships such as J. Charles World Tour and collaborations with Chelsea FC and the Brooklyn Nets. Here are the licenses we hold, ensuring clients trade in a secure and regulated environment. What we offer includes low trading costs, a strong and stable trading environment, 24/7 customer service, our trading center, providing market conditions, insights, and analyst views to support your trading decisions. Beyond trading, TMGM places great importance on social responsibility. We partner with the Great Barrier Reef Foundations in 2022 and 2023 for the annual Sapphire Dinner, a philanthropic event supporting marine conservation. This initiative reflects our commitment to protecting marine life and contributing to the broader community. TMGM also runs large-scale trading competitions to engage and reward our clients. Our 11 TMGM trading competitions feature a total prize pool of $671,500. Clients could join with just $500, and we offer weekly special single awards to encourage participations and rewards top performers. For all clients joining this webinar, we have tailored promotional activities available. If you are in the ROW region, you can earn cashback simply by depositing and trading according to the requirements. Should you have any questions about promotions, feel free to reach out to your account manager. They will be happy to assist. Now, please join me in welcoming Mr. Raffaello, our speaker for today's webinar. Mr. Raffaello is a global macro trader and educator, the creator of the proprietary IMD trading model, and a former hedge fund trader where he managed portfolios of up to $5 million. Mr. Raffaello, the floor is yours.
Hello, everyone. Thank you for being here. Thank you to TMGM for hosting me today. As we said, I am a global macro trader. I trade mainly on fundamental analysis. What I will do today is I will teach you what is the COT report. The COT report is a very famous tool, one tool where you can see the actual positioning of major US-based hedge funds. And even though it's very powerful, it is often misunderstood. So what I'm trying to do today is help you understand how to actually use it, and will also give you a strategy you can implement right away. So let me go ahead and share my screen so we can start. Of course, you can always ask questions in the chat. Also, at the end, we'll also have a little Q&A session. So for any big question, anything that you want to understand specifically, we can talk about it later. For any small question or details, you can put them in the chat and I will be sure to look at them. So COT report logic, how we can trade with institutional insights. Because basically with the COT report, by being able to look at what major hedge funds are doing, we can derive some sort of bias on where the market is going and then trade based on that. At the end of the lesson, you will also have a free tool at the end, sponsored by TMGM, so be sure to be here until the end. Now, to start, who am I? I am Raffaello, as I just got introduced. I trade since 8 years now. I studied computer engineering in Milan, and then I got a degree in economics and finance. I created multiple fintech companies, and as May said, I am a fundamental analyst. I created the inner market dynamics trading model, my personal trading model based on fundamental analysis and global macro. And I'm also the founder and creator of Oracle, that is a fundamental analysis platform that I use to trade. I'm also the founder of the Inner Market Dynamics Mentorship Program, a program where I work one-on-one with people to get them from zero to actual professional trader and then potentially work with me, because I currently am trading for an hedge fund. I have about 6 million euros under management as of now. Where you can find me after the lesson, you can find me on Instagram at urca.fx or on YouTube at Raffaello Ciotta. I do a lot of educational videos on trading. You will find strategies, advices for prop firms, etc. So I recommend to have a look. Now, COT report. COT stands for Commitment of Traders, okay? It was created in 1962 just to increase market transparency, okay, and to give regulators a clear view of who was holding what in the US market. Originally, it was a monthly report, and from the 2000, it has become weekly, okay? Now, the COT report is released every Friday on the CFTC website. The CFTC is the Commodity Future and Trading Committee, okay, in the US. It's basically the regulatory body for trading in the USA. It is released every Friday, but mind you that the data reflects Tuesday positions, okay? So we have a 3-day lag. We can see that the positions we see on the COT report, they refer to Tuesday, but they get released on Friday. So this 3-day lag is something that we need to keep in mind for later, for when we'll talk about how to actually trade with these insights. Now, while the COT report was created as a regulatory tool, as we said, it was just made to increase market transparency, traders quickly realized that it could be reverse engineered to track the positioning of large and informed market participants. So what they did is essentially the CFTC created a public record of where the big money is leaning at any given moment. So it was born just as a regulatory tool, just a means to increase market transparency, but of course traders saw that they could derive an edge from it, and this is what I'm teaching you today. Now, first of all, I told you that we look at the COT report and we can derive a bias from it, but why do we trust the COT report? Because everyone talks about the COT report. It is pretty known, not that much known like, I don't know, smart money concepts, but it's still pretty known. But I saw very, very few people exactly knowing why does it make sense to actually look at it. Now, we have 3 main reasons. The first one is that the reporting level for major currencies, okay, we look at futures data, we will look at this in a minute. The reporting level for major currencies is 400 contracts. So this means that the players, the funds, the hedge funds that are included in the COT report are only big hedge funds, okay, with big players only. Because the standard, for example, Euro FX future contract that is traded on the CME, the Chicago Mercantile Exchange, has a contract size of 125,000 euros. Okay, so if we multiply 125,000 euros for the 400 contracts, that is the minimum threshold to be included in the COT report, we can say that this amounts to 50 million euros. That is something around $58 million. So this is the minimum trade size to be just included in the COT report, to be just one of the many participants. So we can see that actually the persons, the funds, the traders that are inside the report are people that are moving big money. They're not people moving 0.01 lots. They're not people trading with small accounts, but they are actual hedge funds, informed hedge funds deploying billions in the market. The second reason is that the average COT reporting fund, so the average fund that needs to report to the CFTC, has a size of about $560 million. Okay, so COT participants, meaning knowing that the average fund size is 560 million, they have, of course, premium data feeds, they have dedicated research teams, and they make informed decisions, and their decisions are worth billions. So when we see that market participants in the COT report are going long, they're buying euro, for example, we know that the decision that brought them to make this trade was informed, and they are deploying billions, they're betting billions on the market. So of course they will invest a lot in research and they will do very, very informed trades, okay? The third reason, to talk about the third reason, we have to introduce a concept, the concept of open interest. Basically, the open interest tells you what is the total number of contracts that are still open, so not yet, so positions that have not been closed yet on any given asset, okay? So, for example, if we are the only one trading euro futures and we open 100 contracts, the open interest is 100. So looking at the open interest, we can know how many contracts overall are open, either buy or sell, okay? Now, the third reason is this. COT data, so the data we can see from the COT report, represents 70 to 90% of total open interest in market. So basically, we can see that where the main trades are leaning, they amount for about 70 to 90% of all the trades opened on that market in that specific week, okay? So this means that we see nearly all the serious money in the market. So those are the three reasons. First one, reporting level. We have only big players. Second one, the average fund has a size of $560 million. So again, big players with research team and informed decisions. And the third one is the open interest. We are basically looking at the general market consensus here. Most of the liquidity that there is on market is reported in the COT report. Now, how do we actually see the COT report? Looking at the COT report is pretty simple. We just need to go on the CFTC website, okay? And by going down, we will find this current traders in financial futures reports. We will look at this traders in financial futures, futures only, okay? Because futures only keeps the signal clean. Because the other way we can see it is by seeing futures and option combined. The thing is that options are contracts that are used for complex strategies. They are not necessarily directional trades that you do with options. Usually options are used also to hedge a risk or stuff like this. So looking only at futures keep the signal clean, and we avoid basically distortion in notional exposures, okay? Now, I would like to show you how the COT report looks on the CFTC website. I should be able to do this in 1 minute, okay? You should be able to see this right now, yes. So this is the CFTC website. Again, we just need to go cftc.gov, okay? If we go here on this is an US government website, we can just go here on market data and economic analysis, commitment of traders. By going down, current traders in financial futures report, we click here, long format. And this is how the COT look. So this is how we see the raw COT data. It is free, it is not paid, it is not a data that you need to pay for. A lot of people are treating the COT report like it is some kind of secretive place where you can see what are the positions of insiders or stuff like this, but it's not. Like everything is public, okay? Now, back to the presentation to understand how we actually read all of this, because as you can see, it's kind of a mess. It's not very easily, you can't read it easily. Let's continue. So, by going on the COT report, we can see that we have this kind of division, okay? So I took one of the Forex currencies here as an example. I took the Canadian dollar Chicago Mercantile Exchange. So basically here, this red box, we can see the actual asset that we were looking at. So in that case, Canadian dollar Chicago Mercantile Exchange, so CME. The contracts, So every contract here is worth 100,000 Canadian dollars. So for example, if we see here 88,299, this is contracts, okay? So you need to multiply that number by 100,000 Canadian dollar to understand the open interest. Now, you don't need me to tell you that this is a big amount. This is about 89 million Canadian dollars. So it is a lot. Now we have, I'd say, yeah, 4 main market participants that are the dealer intermediary, the asset manager or institutional, the leverage funds, and the other reportable and the non-reportable positions. Now, let's go in order. Dealer intermediary. The dealer intermediaries are basically big banks and market makers, okay? Their role, the way they make money, is by providing liquidity and hedge client flow. So what they will do is they will have a client, they will act as a counterparty, or they will provide liquidity. An hedge fund needs to buy Euro USD. Okay, they want to go long on Euro USD, on Euro in general. They need someone that sells that Euro contracts to them. Those are the dealer intermediary. Okay, so they do not take speculative trades. Their positions are 90% of the time opposite to the speculative side. So they are opposite to where the market is going usually, because they are the ones supplying the actual liquidity. So again, if traders want to buy an asset, they need someone that sells that asset to them. Those are the dealers. Now, they are used in pretty advanced strategies. It's not something that I'm gonna cover here. I didn't cover it neither on YouTube. You can use the dealer intermediaries to understand where the market is about to lean in the next 2 to 3 weeks in a peculiar way, in a particular way. I'm not discussing about this now because it's pretty complex. It's one of the topics I discuss deeply in the mentorship program, but just know that the dealers basically are the ones supplying liquidity to the market. Then we have second market participants, the asset manager, okay, or institutionals. What they do, they are mainly pension funds, okay, insurance companies and large investment managers, okay. Their positions is speculative, but one, they typically hold longer term positions, and second, they use Forex mainly as hedging against international trades. What does it mean? They won't trade on Euro, USD, GBP, JPY, because they are expecting Euro to go up, USD to go down, and so far. What they will do, usually these kind of insurance companies, pension funds, they usually invest into bonds or the stock market, okay? So let's take the example of the stock market. If an European asset manager, an European pension fund wants to invest in US-based stocks, so in American stocks, they can do this only by buying the stocks in dollars, usually, if you want to buy the actual spot, the actual stock, not ETFs. We are not going to do this. In general, just know that they need to actually purchase the asset. If it is priced in dollars, they need dollars, okay? If the pension fund is European based, is in Europe, of course, they will hold their clients' deposit in Europe. So by basically buying assets that are priced in US dollars, like the US stock market, stocks from the US stock market, they are exposing themselves to currency risk. Because, example, if the stock that they buy in the US makes a 10% return over a year, okay, but at the same time, the dollar loses 10% on Euro, the net profit is zero, basically. So what they will do, they will open currency trades just to hedge this risk. So in that case, if the dollar goes down, they will be long on Euro, so they will be able to cover their currency risk, the exchange rate risk. So what they do, they are not directional, they are just hedging, basically. They're just hedging positions mainly on other type of assets like stocks, as we just said, or bonds even more. So we don't care about them. They don't give us important data. They don't give us nothing that can actually be helpful for us to trade. Third part, other reportables and non-reportable positions. Those are traders whose positions usually are large enough to be reported, but don't fit into other categories. So they don't fit into dealer intermediaries, asset manager, leverage funds, and so on. They usually have an erratic type of trading, so they're inconsistent with their behavior, so the signal quality is extremely low. So we don't care about them. Now, there is one missing market participant that we didn't discuss about, and those are the leverage funds. Okay, the leverage funds are actually what we care about. Now, Leverage funds. Who are leverage funds? Leverage funds are hedge funds, actual hedge funds, proprietary trading firm, prop firms, not prop firms like FTMO, proprietary trading firms, private investment fund, the real prop firm, not the one that we use trading CFDs. Okay, they are highly speculative and they have a short to medium term positioning. They actively trade currencies to profit from directional moves. Now, one thing I'd like to tell you, hedge fund, everyone talks about hedge fund, but the definition of hedge fund is oftentimes unclear. An hedge fund, it is basically a type of investment fund that will look to make money regardless of if the market is going up or down. Usually pension funds, they don't do short trade, they don't sell the market, they just will buy stocks, ETFs, etc. If the market goes up, good, otherwise they will lose money. Hedge funds are also actively opening short trades. This is why it's hedge. They need basically to always be hedged, always be in profit, always find a way to make money for the clients. So they are not tied to a specific type of investment like value investment with stocks, ETFs, and so far, but they can also short the market. This is why they are called hedge fund. Just a little curiosity I wanted to give you. Now, with leverage funds, basically, what we can see, they actively trade currencies to profit from directional moves, short to medium term positioning, and they're highly speculative. Who they remind you to? They remind you of traders, of us. This is what we're doing. We are trading currencies. We're actively trading currency pairs to actually profit from directional move. Those are the leverage funds are the market participant in the COT report that is the most similar to us, so we can actually get information from them. This is why leverage funds are so important. They are trading currencies with the objective of making money from directional moves, and they are having a type of approach on the Forex market like us. They are trying to make a profit. They are speculative, not like asset managers that are hedgers, not like dealer intermediaries that make money off commissions, of giving out liquidity to other market participants. Leverage funds are just like us. This is why we care about them. Now, their weekly shifts, the way they change their positioning, specifically the net percent and the net percent delta or change, we will look what this means in a minute, no worries. This often drives Forex swings and then can precede major price movements. So by looking at what they're doing, we can understand, okay, we have leverage funds. They are big as hell. They have a lot of money on their plate. They are betting billions in the market. They have research teams, premium data feeds, quants. They do all of this. Basically, they are stronger than us in general, and they trade just like us. So seeing where they are positioned, of course, is like getting an advice from a very, very expert trader. It's like getting an advice from an hedge fund manager. It would be amazing. This is what we can do from the COT report. This is why the COT report is so strong. But if you look around, usually in some of the strategies that I saw on YouTube from other people and stuff like this, they usually don't even tell you the difference between asset managers and leverage funds. They just tell you, okay, asset manager are longer term. No, they don't actually trade on currencies to make a profit. So we need to understand the reasons why we do something like this. In trading, the biggest advice I can give you all is always to look for reasons. Don't try to follow a strategy blindly because you think that it will make profit, because you see someone actually explaining it. No, always try to understand why. Why should work? Why shouldn't work? Why does it make sense that the market should act like this with this type of approach? Always ask yourself why. Because even by learning an incredible strategy, if you don't know actually why it works, why it should work, what is the logic behind it, you won't learn much. It's like making profits with signals. Maybe you can make a quick buck. Usually it's rare because usually you lose money with signals, but you won't understand actually anything. You won't become a good trader. The way you become a good trader, a great trader, is by understanding why. By understanding what is really happening in the market. This is what changed my life. This is what allowed me to pursue a professional trading career, not like, not dancing on Instagram to sell courses. This is what allowed me to actually also trade for hedge funds. So this is the biggest advice I could give you. Even better than the COT strategy. The biggest advice is look at the reasons. Try to understand the logic about anything. Now, back to us. We were saying that basically, looking at leverage funds is the cleanest read on where the money is flowing right now. How do we actually use them? When we are looking, if we go here, okay, we can see that basically we have all these columns like leverage funds. We have a column here the CFTC website is not the best one and in showing you things in a readable way, but we have columns, okay? So this is like example, the column of leveraged funds, okay? We can see the first column is long, short, and spreading. Long basically tells you how many long positions worth one contract are opened. So remember, we saw that the value for one contract on the Canadian dollar is 100,000 Canadian dollars, okay? So by looking at here, we can see that we have 17,555 contracts opened. It means that we have 17,000 times 100,000 Canadian dollars open. Now, I'm not going to do the calculation. Yeah, it is a lot. I want to do it now. Yeah, it's 1 billion. It's 1 billion Canadian dollars active. I hope I didn't put a zero. No, it's 1 billion and 700 million Canadian dollars open long. Okay, so this tells us how many positions worth one contract are opened as of now in a long side. Same thing here for the short side. In that case, 47,000 short positions, so even more. Okay. Change tells you the difference between the previous week and the current week in positioning. So by looking at total change is minus 1,900 for the long positions, we know that the previous week we had more. Like we know that this week they closed 1,900 long positions and they closed 2,400 short positions. So we can see the change. We can see how they are moving, because always remember this. These kind of players, hedge funds, banks, and stuff like this, they don't trade like us. Like they can just go on the MetaTrader 4 or 5. We can just go on TMGM with low spread and low slippage, buy, bang, and this is open. This is for us. This is the advantage of being a retailer and trading with CFDs basically. But banks, when they need to move billions, they can just push a button and they get all filled. They need to sort of engineer the liquidity. They need to find entry points because they need a counterparty, okay? Easy when you need to open one lot, not easy when you need to open 10,000 lots, okay? So this is different for them also because they're trading with futures, not CFDs that are synthetic contracts. It is another way. Futures are a derivative contract, I need to tell you that. So the main thing is this: by looking at the change there from one week to the other, we can see how their sentiment is changing. If they are now long on the Canadian dollar and they want to close the position, they won't be able to do it in one day or in 1 week in most cases. They need to close bit by bit until they're able to close everything. So this can give us really important information on what's happening right now, okay? Then the spreading here, this column is not very important because it tells you, I tell you just to be, because I care about giving you a complete understanding, but basically it tells you equal long and short positions held by same traders. This is for non-directional institutional strategies like, I don't know, trying to make money on swaps. Okay, swaps, the thing you pay also on the MetaTrader, can be either positive or negative. They are positive is if the interest rate differential between the countries is positive and so on, depending if you go long or short. Again, I talk, so I go too deep in stuff. I don't want to put everything around and confuse you, but in general, the spreading just tells you, okay, for example, if you have a spreading of 5,000 positions, it means that we have 5,000 long and short positions. So basically hedged completely. We don't care about it. Total traders, we don't care. Just tell you basically the total number of funds that are included in these kind of reports for the Canadian dollar and so far. Now, the thing is that the COT report on the CFTC, I have a question, just me. I made super cool explanation. I'm sure not important the COT report. The only problem is that the COT report at the moment are almost a month old since the last government shutdown, where we didn't get anything for over a month. Latest COT report is 18th of November. Yes, this is something I was gonna address in a minute. Just quickly, we will look at this later. The CFTC is a government entity, okay? You should know what happened. So basically, all the major offices went down. We didn't have unemployment data and non-farm payrolls for a lot of time, inflation data. The CFTC also stopped issuing the COT reports, okay? This was from some time in October up to the end of November. I have written the exact dates later, I don't remember that by memory. What they're doing now, since the shutdown is finished, they are starting again to publish all the COT reports, and they're doing them in chronological order. So they are not, as of now, I'm wondering what they're doing, yeah. As of now, they're not publishing them all together. They're publishing every 2-3 days, and they're doing in order. So they did October, now they are, the last one, as Jacopo said, is the 18th of November, and so on. So they will continue to push them out until the 23rd of January 2026, when we will go back again to the normal posting schedule. So as of now, trading with the COT report with the current data we have wouldn't be very smart, because of course we would trade on old data, on lagging data. This is something that of course will get better with time, and in general you will be able to trade again. So what you need to take from this, since we actually don't have immediate COT reports until the 23rd of January, take today, so today is the 16th of December, up to the 23rd of January, and backtest. Backtest the strategy I'm about to teach you. So as soon as we get the COT reports back, you know that you'll be on top of it. Now, back to it. Hope Now, as I said, the COT report on the CFTC website, as we saw, is hardly readable and lacks a lot of important data that we can derive from the number, just doing some math karate, basically. Now, there are various platforms to see the COT in a more readable way. The most known one are Tradingster or bar charts. I'm not showing them, we don't need to waste time, but they are all lacking in some aspects. Yes, they basically just give you the same data you see on the CFTC website, but not in a text file, but like in an actual column with colors. You know, it's prettier to look at, but nothing that actually is needed, because to analyze the COT in a professional way, you don't need charts, you need actual numbers, okay? You need numbers. And this is what I'm teaching you now. Now, this is my COT terminal sheet. This is free for everyone that is watching this lesson or goes on my YouTube channel. By looking at this, we can actually see all the data that matters, okay? This is something I created. It is on Google Sheet. I have also in my Oracle terminal, so I have also an even deeper version in my Oracle terminal. Oracle terminal is just for people that trade with me in the fund or are in the mentorship with me. But can you explain to us how you handled your operation due to lack of the COT after the 18? Yeah, I'll tell you about this in a minute. So on Google Sheet, basically I created it on Google Sheet because it is easy to share. Basically, you need just to give you access to it. So I will explain at the end how to do so. Be sure to be attentive until the end. So this is my COT terminal sheet. Now, this is what we can see. I can show it to you also here. This is the COT terminal sheet. Don't waste time in trying to copy this link because it is locked. It's not public. You always need to be included in this spreadsheet. As you can see, I shared with 478 people as of now. They all came from my YouTube, and we can see pretty much here all the positions from the 27th of May 2025. This is when I created this for the first time. Now, if we zoom a bit, we can see that it's bigger than it looks. Let's now see what we care about. Before going forward, let me answer to Luca. Can you explain to us how you handled your operations due to lack of the COT after the 18? The COT is just one of the data points I use. I use in total 17 data points in my fundamental analysis. So without having the COT data, I would just not use that data point and focus on else like inflation, PMI, interest rate differentials, and all the other metrics I use. So in that case, simply by not having the data, I would just not use the data. Now, you could say, easy for you. You say that you have a complete framework, so it's just one of the data points. How could I trade if I use only the COT report? Unfortunately, you couldn't. Like without the COT report, if you only use this without looking at the broader macroeconomic picture, you couldn't trade. This is the main thing. This is why I always say learn fundamental analysis. The COT report is an incredibly good starting point, and this strategy that I'm teaching you now, I can assure you is better than anything, than any order block or fair value gap you can find. But in general, you need to go even deeper. Just with this, you can be profitable 100%, because this was the strategy I'm teaching you now was one of the strategy that actually allowed me to have my first prop firm payout, make my first good money with trading and so far. But simply, you wouldn't trade. This is why you need to look something else. On a good side, a government shutdown is not something that happens every month. So it's something that happens every 4, 5, 6, 7 years. I don't remember now the last time we had a shutdown. I think it was in the previous Trump mandate, but it's not something that happens very often. So 95% of the time you can trade without problems. In that specific time, in that specific period with the recent shutdown, I simply I give a score to each data point. I just left the COT at 0 because, of course, not having the data, I couldn't score a data that I don't have. If you just add this, you wouldn't have much to trade on. But again, something extremely rare. Okay, let's get back here. Okay, now, what are the most important metrics that we can find on the COT report? I will explain at the end how to get access to it. Okay, it's free for everyone here. I'm not selling this. I'm giving everything for free. I don't need to make $20 a month of this. I don't need it. Now, this is created. This is created by me. We get the data from the CFTC website. It's just a bunch of code I created. Lucky for me, I actually studied computer engineering, so I still remember how to code. So I just basically I pull the data from the CFTC website every weekend, and then I interpolate, I do a lot of calculation to get all derived data, like the open interest total USD, net percent LF, net percent delta, and so far. Let me explain it now. So the most important metrics are open interest total USD. This tells you how many dollars are at market on any given currency. This is calculated by multiplying the open interest for the contract value in dollars. So for example, we can see that billions dollars. Okay, so this tells you how deep is the market, how much liquidity trading at market as of now. Other part is short positions. Net positions simply is the difference between long positions and short positions. So it tells you if we have more market participants going long or more market participants going short. Right? Very simple. The other thing that we care about is the net. This is the most important metric, this column here. The net percent left shows you how much of the entire market is controlled by leverage funds in terms of net positioning. Okay, so as an example, it's easier to understand that to explain. LF is 25%. LF stands for leverage funds, of course. If net percent LF is 25%, it means that leverage funds control 25% of the market with a long bias. If it was minus 25%, they would control 25% of the market with a short bias. Okay, so it tells you how much of the market they are controlling and with what bias. So example here on USD, we can see minus 28.21%. They are controlling 28.21% of the total open interest at market with a short bias. Okay, incredibly insightful metrics. The net percent LF delta, this little triangle is a Greek letter, delta, that means change basically, tells you the change in net percent between the current week and the previous one. This gives us context. It tells us if the movie is coming to an end or if leverage funds are continuing to fuel their positioning. So if we see, for example, here, minus 28.21% net percent LF, net percent LF delta minus 14.11. So basically, from the previous week, they increased the short positioning. They went even more with an additional minus 14.11% in net percent LF. Okay, so they are continuing their position. For example, on Euro, 19.22%, the delta is 2.92%. So they increased this week with their positioning by 2.92%. Okay. The net value USD tells us how many net dollars are pushing the price, specifically in any given direction. So for example, we can see USD net percent LF minus 28.21%. The net value USD is minus $598 million. Okay, so we know that we have about $600 million pushing the price of dollar down. Okay, For example, on euro, we have 4 billion, almost $5 billion pushing the price of euro up, okay? Extremely important metrics that we don't have on the CFTC website. We need to derive that with a bit of mathematics. Now, as I was saying before, the COT terminal sheet is updated every Saturday morning Central European time, because remember, the CFTC publishes the COT data every Friday, okay? So I updated the Saturday morning, it's at, I think I put it at 6 a.m., 6 or 7 a.m., something like this. And I was also saying the terminal sheet pulls data directly from the CFTC website and generates new data with a custom code I personally made. Now, this was the note I was talking about. The CFTC paused COT publications during the recent US government shutdown and has just recently resumed releasing COT report after the suspension from October 1st to November 12th, okay? So they are currently publishing all the missing reports in chronological order, which means new data will appear with a natural delay. The COT terminal is being updated in line with each official CFTC release, and normal publication scheduling is expected to resume on January 23rd, 2026. This is at least what the CFTC told in a report on their website. Now, to generate our bias, we look for strong and inverse percentage positioning in currencies. AKA, so we look to pair strong long net percent LF currencies with strong short net percent LF currencies. What does it mean? We look to find, we need to find the currency that has the higher net percent LF bullish, okay, and the lowest net percent LF, so it's bearish. In that example, we see JPB has the highest net percent LF, plus 44.49%. No other currency is higher than that. CAD has a minus 40.65%. No other currency has a net percent lower than that. So we can know JPP is the most bullish currency on the COT report and CAD is the most bearish currency on the COT report. We compare, and JPB CAD, the pair will have a long bias in that case. So we'll look for buy trades next week. Okay, this is the general way on how you create a bias. You need to get the CFTC website. You need to understand what you're doing. First, I already told you, you need always to understand why you're doing something. You understand this, you get the data, you derive the net percent with all the calculations. You don't need to because you have the COT terminal sheet. And then you just pair the strongest net percent left. So the strongest net percent in exposition of leverage fund currency with the weakest, so the one with the strongest short push. Okay, this is how we create our pair. So in that case, JPP strongest, CAD weakest. JPP CAD, of course, is a long, because if we're going long, if we're buying JPP CAD, we are betting that the pound sterling will gain power against the Canadian dollar. Okay. We must carefully look also at the net percent change or delta. Again, delta is the same thing. A net signals us that we reached an extreme in positioning, okay? And we might start reversing or simply is leverage fund taking profit, because as I said before, they can't take profit like this. They can just close a trade like we do on the phone. They need to engineer liquidity and to slowly get out of trades, okay? So if we are long since a lot of time, okay, and we see that the change is starting to become negative, so we saw that they are starting to unload positions, maybe they are preparing to reverse, so they are trying to reverse their position going short in that case, and this could actually deteriorate our signal quality. Or they're simply taking profit. Of course, now on the MetaTrader, we just close position, we don't see what we're actually doing, but in reality, to close a long position, what do you have to do? You need to sell. To close a position, a buy position that is in profit, you need to sell. And to close a sell position that is in profit, you need to buy. So of course, you will need to open the opposite position to close your current trade. So in that case, it can just be leverage funds that are just taking a bit of profit. This is what they're working for. They want to take profit, of course. We just need to keep this in mind. Remember, always that hedge funds can close billions in positions in a couple of days, so to unload all their trades, they might need multiple weeks. So be mindful of that. Now, what we're looking to do, the bias from the COT report derives from the ability to find and to understand what is a strong currency and what is a weak currency. If a currency has been let long for quite some time and we see hedge funds starting to unload by noticing lower net percent LF and negative net percent LF change, we can logically expect the currency to weaken. On the converse, a weak currency that is already going down since a lot, if it has been net short for quite some time, and we see hedge funds start positions, the currency to strengthen. So position, we need always to be mindful of that. Now, how do we actually trade? You might ask. Here is the strategy. This is the leverage fund strength index, and it's a 4-step strategy you can implement not right away because, of course, as Luca and Jacopo said, we don't have updated COT data as of now, but yet you will be able to practice a bit with this kind of strategy to then implement it from January, okay? So, first step. See, what are the steps? The first step, during the weekend, we find the strongest and weakest pair for the week. So we find the one with highest net percent long and lowest net percent short, okay? We then validated the LF strength index for each currency. What is the LF strength index? I will show you this in a minute. We need to have net percent LF and net percent LF change to agree. If they don't agree, so if they're not the same, we don't trade. So if we have a positive net percent LF, but the last week, the positioning, the change was negative, so they unloaded positions, we won't trade. We just want to see positions that are actively being fueled by market participants, by the COT participants, okay? Then we need to look, is the strength score for the pair, so we'll drive a strength score for each pair, higher than 25% for a long trade or lower than 25%, at minus 25% for a short trade? If yes, we can continue and go to our trade execution. Now, of course, this looks confusionary. You will now understand better because we will see step by step. So, one, on the COT terminal sheet, you will be able to see here that we have another table. If we go on the right, we have for every week this table, the LF strength index. So what this is the terminal basically automatically pairing all the currencies to create 28 tradable pairs, okay? So by looking at this table that, again, we have every week, basically, okay, we can understand, okay, I might have a bias on a particular currency. Let's move forward. So again, by looking at this, we know that the terminal sheet automatically pairs all the 8 major currencies, creating a 28 pairs tradable universe. The currency percentage scores are normalized to a range of minus plus 100 and 100 from left to right, that is here on the top left, and the weakest that is here on the bottom right. Okay, so they simply pair the currencies. For example, if we go back on JPP CAD, we would have JPB plus 44%, CAD minus 40.65%. By pairing it, we know that JPP CAD is plus 84, 85%, something like this. Okay, then it normalizes it in minus 100% to plus 100%, because otherwise we will get, I don't know, a currency that is plus 60% and one that is minus 60%. It doesn't make sense to have the pair plus 120%. So everything is normalized from minus 100 to plus 100, right? So this is the first thing. The second step is we will scan the LF strength index. So we'll scan the actual table from the strongest to the weakest pair to find one long and one short opportunity for the week. We don't need to open 60 trades a week. One long and one short is all you need to become profitable and to live off trading. You don't need to trade necessarily a lot. We need to follow one simple rule to do this. To validate a tradable pair, both the strong and the weak currencies, LF net percent needs to agree with the LF net percent change. So, for example, to validate a long on JPP CAD, JPB LF net percent change needs to be positive and CAD LF net percent change needs to be negative. So, of course, what I mean is that to trade on JBP, we need to have the net percent, of course, positive if we want to go long, But this also needs to agree. We can't have a negative change if we have a positive reading. We need actually to have an agreement, like on Euro. We can see that Euro, the net percent LF is positive, and also the change. So what they did this week is positive. They are reinforcing, they're fueling the position. If we see that this doesn't happen, we don't validate the pairs and we move forward. Okay, of course, the opposite is also true. For CAD, that is negative, I want to actually see a negative net percent change, right? So after this, we can see that JPB CAD, we have a long bias. This is the strongest pair for this week that I took as an example. It's not the last week, it's the same week I used as an example in my COT video on YouTube. I'm doing the same example, okay? So JPB CAD was the strongest pair. It was July 29th, okay? But by looking at JPB, we can see that the net percent LF is positive, yes, but the net percent LF change is negative. So we move to the next pairs. We won't trade JPP because we don't have an agreement between the net percent LF and net percent LF change. So of course, logically, we skip all the JPP pairs because of course JPP would always give us a false reading. It will also be in disagreement. So the first pair we have without the JPP is Euro CAD. Okay, let's validate Euro CAD. Euro net percent LF is positive. Net percent LF change is positive, so Euro is validated. CAD net percent LF negative, minus 46. Net percent LF change also negative, so Euro CAD is also validated. So Euro CAD is a long bias that is actually validated. Third part, the actual score we see on LF strength index needs to be higher than 25% for a long trade and lower than minus 25% for a short trade. Is this one higher than 25%? Yes, so EuroCAD long is confirmed. This is all the job, all the chores, all the work that we need to do during the weekend. So we will do this analysis on Saturday or Sunday, and if this was Saturday or Sunday, I would say, okay, perfect. Now on Monday, I know that I have a confirmed bias on EuroCAD, a long confirmed bias on EuroCAD, so I will look for long trades. And this is exactly what we do in the first step. We just go and do the execution. This is the example I did on YouTube. This was a very, very easy trade, to be honest. Now, it is kind of hard to explain it from here without TradingView. I don't have the time to actually go on TradingView, but to enter them, this is a bias generator. Okay, it's not a signal. It's not like, okay, I see EuroCAD long, I just go long immediately without even looking at the chart. You have a bias, so you know that was okay. It's a good balance. Time frame. I use the 2 hours, for example. It's a very strange time frame, but it's not necessary that you use it. 1 hour is quite enough. It's completely enough. So use higher time frames, and you basically just need a very, very simple entry point. You don't need complex strategies. You don't need to see external liquidity, internal liquidity, all this lingo that they use today in trading that unfortunately I know, but I don't use anymore. You just need basic entries, okay? What I did specifically here, I have those black levels you see, those are this is one of my personal indicators, the institutional nodes. Those basically serve as pivot points for the market, okay? I'm not going deep on this now, but what you could do is simply use even support and resistance. You don't need a lot. You can just pair support and resistance with structure. So for example, here, let me see if I'm able to take notes on my screen. Yes. What we can do pretty much here, we can see a very simple setup that would have been the same. We can see we have basically a support here that serves also a resistance. Yeah, a support. It was a resistance in that point that since the market broke up, now it serves as a support. We can see that the current structure is in our favor because we saw a big push to the downside here, okay, another big push, then an inversion. We see that as of now, the current structure is bullish, okay. This is a retracement on this level and the entry was here. Very, very easy. This was on 150 pips trade. The other target I would have had was this other level, so this high that also is paired with an institutional nodes, this one. And if you go look at the chart, this is the screenshot I use on YouTube. This is exactly what the price did. If you go and look at the chart in August of EuroCAD, you will see that the price actually arrived here in my original target. So once you have the bias, you don't need to overcomplicate your strategy. You don't need to hyper complicate the way you look at the 1 minute entry, go and scale down your time frames, look at the precise wick. No, you don't need neither to have a 5 pip stop loss, because this is what will kill you. I talked about this in one of the videos, on my videos on YouTube, on why using tight stop loss is actually killing your profits in trading. You don't need to trade on lower time frame, and you don't absolutely need to open a lot of trades. You just need one long trade and one short trade. This was the example for the long. You could derive the example from the short yourself by looking at the data. Would be Euro JBP. That wouldn't make sense in that case, because we wouldn't validate all the strategy. But then after you get the bias, you don't need a lot of complexity to actually trade. This is the thing. This is the same thing I do with fundamental analysis. 80-90% of my trading is fundamental. We get the bias, and I can see this because I see that in the webinar there is also some of my students, so they know how we actually trade. Once we have the bias, we don't need to overcomplicate stuff. We don't need to do hyper complex things. It is enough to find a good entry point and to trade on higher time frame. As you saw, for example, here the trade was extremely simple. Since we had a long bias, it was enough to analyze a support, okay, and a market structure. By looking at a support and by looking at this market structure, so with a break and retest on the super, basically we could have made 150 pips with, in that case, guys, it's zero. I think it's like 2 ticks of drawdown. It's less than 1 pip of drawdown. You can see that the price actually used the level, my level, as precise as a sniper. So this is basically the strategy. You need to follow the 4 steps. The 4 steps are easier said than done. Are easier done than said. It's actually easier to do it than it is to explain it. We just need to find the strongest and weakest pairs. We validate them by looking at the net percentile left that needs to agree with the change. Once we found an actual pair that satisfied the second step, we go on the third one. If the score is higher than 25% for a long trade or lower than minus 25% for a short trade, we have our buys and trade and pair confirmed, and then we just need to look for an entry. For the entry, you can use simple concepts. Don't use tight stop losses, okay? Use normal stop losses. Trade at least on the 1 hour time frame, and look mainly at structure. Now, the way I read structure is peculiar, is singular of my YouTube videos, but of course, try to understand that in trading, you don't need to overcomplicate things. You need to use things that resonate with you, things that are logic, and then just implement based on a bias. This is the thing. You need a bias. The COT can give you a bias. This is why what allowed me to make my first payouts and my first actual real money in trading, because it gives you a bias. This is what I'm doing now in a more complex way, also introducing the COT inside with fundamental analysis that gives me a bias. Once you have the bias, the entry is the easiest thing of them all. So focus on that and focus on understanding why a concept should make sense. Are you using, I don't know, order block? I don't particularly like them, as you might have understood. Why does it make sense that institutionals are selling and then buying the same positions where the market is retracing? I don't even remember what was the fantasy story behind order blocks, but does it make sense? Always ask you this with everything you do in trading. I see one question. How are the percentage calculated in the Forex asset table? I missed that. Very simply, what we do is basically we go on the COT, we see the net percentile left and the net percentile left delta, and we pair all the pairs. With 8 currencies, we can create 28 tradable pairs. Okay, why 28 and not 64? Because of course, Euro USD is the same thing as USD Euro, but you won't trade USD Euro. Okay, so what they do is simply JPB CAD. We get the net percentile left of JPB. We get the net percentile left of CAD, and we add them. So in that case, for JPP CAD, if we have JPP at plus 44%, it's 44.49 plus 40.65. Why plus, even though CAD is a negative? Because if I'm going long on JPP CAD, the CAD is the quote currency, so if it is going down, the pair is going up. So the score here is 85.14%, But in the table, you won't see 85.14. This is not even the same table I used in the example. But you see the score that is normalized, because as I was saying, if we have, for example, plus 60, minus 60, we would have 120%. It doesn't make sense. So this is normalized from minus 100% to plus 100% to make it make sense in that case. So for example, an 85.14% would be something around 42.6% in the LF strength index here. Any other question? Okay, we can continue. So this was the execution. I said anything simple can be used. Don't look at lower time frame, look at big time frame. And is it possible to do this process of work with COT? Yes, it is absolutely possible. My COT terminal sheet doesn't include gold on the spreadsheet. It is included in the Oracle terminal, but you can still get the data from the CFTC and do the same reasoning yourself. So yeah, absolutely. You can do this with any pair, any currency, any asset that you can find on the CFTC. Potentially, you can do this even with soy or cotton, because we have them also on the CFTC website. The logic is the same. This is why also this is strong, because it is its roots are into logic and cause and effect. So you can apply the same concept pretty much everywhere. Now, let me tell you how you can get access to this COT terminal sheet. As I said, it's either on YouTube or faster, it's here. After the lesson, again, you can find me on Instagram at rca.fx. I post about trading pretty much every day. Same thing on YouTube at Raffaello Ciotta. You find all lessons, strategies, things that you won't find anywhere around in trading. Okay, so we have trades on the COT report, the COT flip, that is another strategy, trade with stop losses, understanding how to trade profitably without getting taught in the marketing scheme of trading and stuff like this. How you can get access to this COT terminal sheet. Now, in some minutes, in the chat, TMGM will post the link refer to this webinar to register with TMGM. Anyone that is creating an account with TMGM in this with this webinar link, so from this webinar we'll get the CO3. So once you register, your account manager will contact you to give you access. So we just got the link in the chat box. So if you register an account with TMGM, you get the COT terminal sheet for free, sponsored by TMGM. You can find this also on YouTube. I would love to thank you again, TMGM, for hosting me. And I think, yes, that's pretty much it. As I said, once you register, your account manager will contact you to give you access to this COT terminal sheet. You can contact me on Instagram if you have any question. I'll do my best to get back to you as soon as possible. And if you have any other question about this, I'm still here for a couple of minutes. Otherwise, I'll catch you soon. I hope you will find me on IG and YouTube. Thank you guys. I see the chat. It was a pleasure.
Okay, thank you, Mr. Raffaello, for the great presentations and the live Q&A sessions. So, last but not least, we would like to highlight the webinar promotions for one last time. So for all the clients attending these sessions are eligible once you deposit and trade based on the criteria. It is very straightforward. Trade, earn, and enjoy the rewards. So that wraps up our tonight's sessions. From trading services and global competitions to community initiatives, TMGM is committed to building a supportive and rewarding environment for all our traders. So thank you once again for everyone joining us today. If you have any questions, feel free to reach out to our team or your account manager anytime. Thank you and have a great evening ahead. Goodbye.
Shimmy. Oh, he's done it! The Wolves booze turns to Chelsea tears.
Going to break for Nkunku, and he's going to hammer it in. Mudryk takes over, Mudryk's through, Mudryk round the goalkeeper! Oh, it's fantastic! Mikhailo Mudryk!
Cole Palmer, time to smash it! Now Chukwuemeka, lovely shimmy, brilliant! Strong turn from Jackson into Palmer, that's brilliant! Oh, Cole Palmer! We know he's got the pace. Madueke's in the middle, so shall Felix!